Our conversation forward. The market, in a sense, is giving entry points for a lot of long-term investors, given that we do have to deal with this new virus variant fear. Saurabh, good morning. Thank you for joining us. It's been a good year, Saurabh. It's been a good year for small cap investors, mid cap investors, and for value and quality investors like yours. What's in store as we unwind the year and move from 2021 to 2022? What is in store for us?
I think life becomes a little bit more predictable because obviously a year back, none of us really knew where we were going in terms of the economy. As far back as March 2020, in fact, Nikunj, it was on your program, I remember, when the market went gap down. It was pretty clear to us at Marcellus that we will have an enormous bull market on the back of unprecedented global liquidity. But that being said, even we weren't really 100% sure a year back how quickly the economy will recover. The good news now is the economic recovery is fairly robust. It's broad-based, it's global, and therefore the year ahead of us, the economic uncertainties actually are quite muted, if you ask me. Where I think we might have to focus a little bit more on is the geopolitics. The whole Russia-Ukraine situation, the Chinese aggression generally, the situation in Afghanistan. So economy-wise, 2022 looks like a more predictable year than the one that we've just gone through. I think the COVID story is relatively well understood now. There will be various waves of COVID. The medical establishment, the health authorities globally are fairly alert and awake to this, and therefore the economic disruptions from COVID will be much more muted in 2022 than they have been over the last couple of years. Now, if you have a solid economic recovery, the best way to benefit from it is invest in high quality lenders, high quality financial services companies more generally. If you want to be a little bit more aggressive, look for companies which are plays on the real estate recovery. We are doing that through building materials, but other people on this watching the show might have other ideas. And more generally, manufacturing, capital goods manufacturers will also have a solid 2022.
So given that the positioning of the economy will be slightly different, the so-called Capex economy comes back, it is going to be very different than what we've seen in the last couple of years. Does it prompt you to also somewhere not change your portfolio but tweak the allocation, which is that if you own 5-10% in Asian Paints, you want to make it 8. If you own 10% Pidilite, you want to make it 7. Are you thinking on those lines where you want to extend the number of names in your portfolio, given your view in the economy?
So we've found consistently that running concentrated portfolios in India, say portfolios of around 15 stocks, we found that running concentrated portfolios in India gives our clients the best risk reward balance. Where I agree with you is as it becomes more obvious that we are in for at least a 2-year, perhaps if you're a little lucky, a 3-year recovery around the world, plays on economic recovery become more attractive. And I would submit to you that more than conventional capex, right, more than putting sort of bricks and mortar into the ground, in a way, tech is the capex of our era, and therefore Indian IT services firms, the big Indian IT services firms, become plays on the global economic recovery. In sort of very specific terms, firms like TCS, L&T Technology Services, and both of these belong to our portfolios. These sorts of companies are now the engines of global capex, because large Western companies come to these companies either for conventional IT projects around cloud, around mobile, around SaaS, or in the case of L&T Technology Services, engineering R&D. If you want to sort of be more conventional about it and look for capital goods plays, we've historically struggled a little bit, I have to confess, convincing ourselves that, say, power generation, transmission, distribution, that there's too much money to be made there because the cost of capital, the free cash flow generation in conventional energy, power related plays tends to be modest. So we have in our portfolio a company called Grindwell Norton, which is a light industrials play, and it plugs into the economic recovery quite nicely. We're looking for more such plays, capital goods companies, light industrial companies, which can give us a more pronounced play on the economy.
Mm-hmm. Saurabh, one hallmark, at least in my book, has been that in 2021, we saw birth of internet companies in the public market, whether it is Nykaa or Paytm or Policy Bazaar or Zomato. That's been one differentiating factor. What for 2022 could be that big hallmark factor which you would be monitoring?
I think what we are looking forward to actually is Indian companies which are plays on the more conventional aspects of life in our country, which is, go to market, sell something which the Indian consumer wants or the financial services sector needs, execute well, use plenty of tech and generate efficiency in your business processes, have low working capital cycles, high asset turnover, and therefore generate high ROCs. We're looking forward to more such companies coming to the market. We had a little bit of that last year, but our reckoning is that the coming year will also bring some IPOs, which are more in the classical mold of plays on Indian consumption, where you and I can see a large market which is not yet consolidated, like say paints or adhesives has become, and we basically invest in a company which goes on to consolidate a large market. If you ask me, this is a massive opportunity. There's so many more sectors where the consolidation is yet to happen in our country, that it's quite mouth-watering actually if you look at the Indian economy and see how much wealth will be created in the next 10 years as you consolidate the sector. The last 10 years, the Indian stock market created $1 trillion of wealth. I reckon the next 10 years, the Indian stock market could create the best part of $2 trillion of wealth, right? So 2000 to 2010, the market created around 0.5 trillion of wealth. 2010 to 2020, $1 trillion of wealth. Next 10 years, potentially $2 trillion. And plays like the formalization of consumption, the shift from the physical assets to financial assets. These are epic themes. So much wealth waiting to be created there.
Good morning, Saurabh. So is that the theme that you're going to play for the new fund that you may also be coming out with, the banking franchises? You have been talking about it. In fact, even at the recent sell-off, you did describe it as shallow. I know Nikunj asked you about the banks, but how would you actually play on that larger theme?
So look, I think in the Rising Giants fund that we've started raising around 3 months ago, will carry on focusing on small to mid cap being 3, 4, 5, 6 billion dollar companies, which are plays on, say, financial services, so high quality lenders. Say Navas Financiers, to our mind, is a classic play on that space. It's a well-run housing finance company focused on a specific niche in Western India, uses technology effectively, generates return on equity above cost of equity, strong balance sheet, impeccable pedigree of the backers of Aavas Financiers. So we're looking at in Rising Giants, if you ask me, 3 themes that we are looking to play is well-run financial services companies which will benefit from the next 2-3 year economic recovery, specialty chemicals, which has been a favorite of ours over the last 2 to 3 years. So we've discussed these names several times: GMM Pfaudler, alkyl amines, and there's a couple more in Rising Giants. And the third theme is, as you were discussing, the potential for well-run capital goods companies which are high ROC, cash generative, rather than being low ROC and struggling for cash flows. So we're looking for more Grindwell Norton type companies in the Rising Giants fund. So specialty chemicals, good quality financials, and the capital goods place. If we can bring them together in Rising Giants, and so far the going looks good, then I think 22-23 will allow our mid-cap fund to capitalize on this. What looks so we are, as you'd expect, we're discussing, and I think Nikunj read my mind there. So we're discussing whether the building materials companies deserve further allocation. I think everybody on watching this knows that we are seeing some highly elevated levels of activity in residential real estate purchasing. And as I've said several times, the best way to make money from residential real estate is not the developer, but the supply chain which plugs into resi real estate. So clearly the paint demand story, the adhesives demand story, the pipes story, and we increasingly also looking at electricals. These sectors are buzzing. Volume growth is pushing towards mid-20s, high 20s. I'm not just talking volume growth YOY. Even if you do volume growth today versus 2 years ago, you've got mid-20s volume growth coming through in building materials. And therefore we reckon there's more money to be made here. question, therefore, is should we increase allocations to this entire building materials ecosystem, where if you take one champion in adhesives, one in paint, one in electricals, one in pipes, perhaps one even in tiles, you can plug into the entire boom in real estate and make solid money for the next 2-3 years without having to worry about the balance sheets of these players. So that's actually one of the discussions taking place in our research meeting today.
Even if you've thought on this, I'm going to force you to think again with my next question, and I'm going to take a leap from your comment on we have a potential of adding $2 trillion of market cap in next 8 to 10 years. So which are the companies which, to your mind, will take a leap to the $500 billion club? Because if you have to go to $200 trillion, there could be 2, 3, 4, 5 companies which definitely would be a $500 billion company. Today we have just two, Reliance and TCS.
Yeah, lovely way to put it, Nikunj, and thanks for simplifying it and appreciate that. So look, I mean, we've discussed relentlessly in our books, right? Diamonds in the Dust recently, Unusual Billionaires 5 years ago, that the great Indian compounders can crunch out 10x in 10 years for you. 25-26% compounding is 10x in 10 years, and the great franchise in our country consistently do it. A Titan, a Pidilite. If you look at the last 20 years of data, these are 30% compounders over the last 20 years. So if you take a view that 10x in 10 years is feasible, you're looking for companies which are around the $40-50 billion mark today, right? And if they do 10x in 10 years, they'll be pushing that $500 billion mark in market cap. So amongst the stocks that we own today, if I had to choose three, I would start with Bajaj Finance. Incredibly well-positioned company, not just because they've done well in the last 10 years, but their technology stack looks really, really powerful. I mean, people talk about fintechs in our country. This, to my mind, is by far the most powerful fintech, the most number of developers, the greatest amount of investment in coding, in AI, in ML. So Bajaj Finance would be my pick number one for hitting that $500 billion mark. Asian Paints, simple story, right? We've discussed it so many times, 22% cash flow compounding, decade after decade after decade, right? If you do that, you're a highly likely candidate for 10x in 10 years. They've done that for 40 years, I think, and I don't see why they won't do it for the next 10 years. They're again at the $40 billion mark today. Good candidate, I reckon, for a $500 billion market cap by the end of the decade. And you can't ignore TCS. I know they're already big, but again, 25% free cash flow compounding the entirety of the century, the scale gorilla in Indian IT. Nobody gets even close to TCS, the sheer scale of their operations. But more importantly, the supply side. They're the strongest trainer, retrainer, recruiter of talent. $500 billion in TCS should be very, very doable a decade hence. Three companies, $1.5 billion, 10 years out, highly likely. Our entire market cap today of the country is $3 trillion.
Okay, fair point. A very basic observation here, which is that there is something called mean reversion and law of averages. Bajaj Finance has been a multi-bagger. Even multi-bagger does not capture the kind of wealth it has created. Asian Paints has been a multi-bagger. TCS, from its IPO, it's given a CAGR return which is in double digit. If you are looking at these stocks reaching the kind of levels which you're talking about in the next 10 to 8 years, don't you think somewhere law of averages and mean reversion could also kick in?
I think that's a beautiful question, Nikunj, and this is exactly what people like Howard Marks have said, that what technology has done, and he spoke about it in the US context. Let me Indianize what Howard Marks says. So what Howard Marks says is what technology is doing is, because the collection of data and the analytics around data give you such a comparative advantage, that companies that specialize in collecting data, teasing out business intelligence from it, using it, have an inherent advantage in compounding away year after year. Right? And Amazon is a powerful example. No company in the history of the planet has compounded for as long as Amazon has, with as much ferocity. And every time that people expect Amazon to mean revert, it doesn't, because it's feeding off virtuous cycles around technology. In our country, there's an added dimension which utterly changes the economic paradigm today versus 10 years ago. We are integrating this nation, right? GST, UPI, mobile connectivity, so on and so forth. the Indian economy today is far more integrated than what it was 10 years ago. 10 years ago, it was 20 fragmented economies sort of cobbled together with sellotape. If you integrate an economy, the canvas on which these highly efficient companies operate, the canvas expands, and therefore the scope for mean reversion is far less. And I think this is one of the fundamental disconnects, I think, between a lot of investors who are investing in India today. Their mental model as of the world as it stood 10 years ago, they've neither got their heads around how technology has changed business, nor have they got their heads around how our country has changed in the last 10 years. And if you put these two together, the canvas for well-run companies, whether they are at $3 billion market cap or at $30 billion, the canvas is different. There'll be fewer winners. But the winners will be bigger winners. In the last 10 years, 16 companies, just 16 companies have accounted for 80% of the wealth created in the Indian market. In the decade prior, 2000 to 2010, it was close to 30 companies that accounted for 80% of the wealth created in India. So the number of winners is going to come down. But those winners will be bigger winners. And that our job, our work as a fund manager becomes to spot those winners early, get in there and stay calm and ride that upswing as technology and economic integration combine very powerfully.
Saurabh, we touched upon it briefly, but just to build upon it as well, what we've seen in the primary markets, especially since our last conversation with the Paytm as well as Star Health, which will be, of course, listing later today, the lessons that have been, of course, there for the merchant bankers as well as the promoters of all of these companies. But, we've also seen capital reallocation. I remember you saying not all of these IPOs will work. It'll just be maybe 1 out of 10.
Yeah, so I think the lessons of history are very clear, right? That most Indian companies that you and I come across struggle. They struggle on governance, they struggle on competence of the management and the promoter, and they struggle because of the competitive intensity in our country. So historically, if you look, say if you take the BSE 500 as it stood 10 years ago, 85% of companies haven't even given shareholders a return equal to their cost of capital, 15%. So 85% of listed entities as of 10 years ago have failed to deliver a return on capital equal to your and my cost of capital. So just 15% of listed companies are actually worth even considering for investment. And when you look at IPOs, typically the win ratio is even lower. In the stock market, it's 1 in 6, but in the IPO market, amongst new listings, the win ratio goes down from 1 in 6 to 1 in 10. And hence my point to people, be circumspect. Of every 10 companies that are going public, only one will be a long-term consistent compounder for the people watching this show. And there shouldn't be any great rush to sort of invest in IPOs. There's no train that is suddenly going to leave the town. You've got enough high-quality companies listed, and the data is clear. The data is telling you no more than dozen and a half companies will really create wealth for you and me over the next 10 years. So why run after every IPO?
Okay, don't run after every IPO. Market also certainly seeming frothy at this juncture. When you talk about franchises, and we've heard about so many sectors from you, Saurabh, but also with what's just happening globally, one thinks more now about pharmaceuticals. Yesterday, we were even talking about if this is the time to go overweight on pharmaceuticals and how the stocks have been performing. What about from that perspective, franchises from healthcare, be it hospitals or pharmaceuticals?
Pharmaceuticals is actually a little deceptive as a sector. You would think pharmaceutical companies would generate lots of free cash flow, but many of them don't, right? Many of them don't because their moats are actually quite shallow. Most of the pharma companies are operating in markets which are highly price sensitive, and they're basically operating on a cost arbitrage and selling the product from India into highly regulated markets where prices get squeezed right down to the bottom. And hence, free cash flow generation by Indian pharma companies is actually fairly elusive. It's in that context that Abbott and Divi's have been our investments. Both firms have high competitive advantages, high moats, ROCs therefore pushing towards 40%, and the ability to consistently compound free cash flows at 20-25%. So just be little careful of pharma. It's obviously more stable as a sector than say sectors like capital goods, which we were discussing a few minutes back. But the moats of Indian pharma companies are far weaker than people realize, and hence we've found more joy in investing in specialty chemicals in companies like GMM and Alkyl, which supply the Indian pharma companies, right? This is it's a consistent theme in Indian life. The front end B2C company often doesn't have a great moat. The real estate developers, the pharma companies. It's the back end suppliers who are consolidated, who've got very high bargaining power, who end up getting the 40% ROC. And if they reinvest well, 20-25% consistent free cash flow growth, and therefore 10x in 10 years for people like us.
Okay. Well, that's all the time we have today, but Saurabh, it's always a pleasure having you on the show. Thanks so much for joining us live today.